All right, let's switch gears and look at the EV space. Chinese EV maker NIO set to report earnings tomorrow morning. For a preview, we want to bring in senior markets correspondent Kevin Green. So Kevin, what is the street looking out for from NIO?
Yeah, expecting a little bit of implied volatility or some volatility post this report here. The market's expecting around 12.4% move either to the upside or downside post the earnings. And unfortunately, we are seeing a slide here when you're looking at pretty much the whole EV space this morning. A lot of these stocks are down about 4% after getting some of the Chinese data over the weekend regarding sales.
Plunge, recovery, and catalysts. We can't really deny that NIO stock has been on a wild ride lately. Just glancing at the numbers tells the story. A plunge of over 20% in March alone, leaving it down nearly 50% for the year. In this video, we're diving into why this happened and what could turn the tide for NIO. Experts weigh in on the factors behind the drop and whether there's hope for recovery. So, what's next for NIO?
But once again, we see these price wars happening in China and even in the Eurozone, and that's putting pressures on margins across the board here. So NIO definitely has a significant amount of market share, but once again, they're just not up to the production level yet to turn consistent profitability here in the near term.
Starting with an optimistic analysis, an analyst from the Motley Fool thinks NIO's recent stock plunge presents a potential opportunity for recovery. The plunge, totaling 21.7% in March and a staggering 47% for the year, was primarily triggered by disappointing fourth quarter and full year 2023 numbers. While fourth quarter deliveries showed a 25% year-over-year increase, they fell 9.7% sequentially. Additionally, despite a 31% rise in deliveries for the full year compared to 2022, NIO's gross margin dropped to 5.5% from 10.4%, leading to a net loss surge of almost 44% to $2.9 billion in 2023. This performance dampened investor sentiment amid a slowdown in the global EV market. The downward pressure intensified further when NIO revised its first quarter delivery guidance to 30,000 units, down from the earlier projection of 31,000 to 33,000 vehicles. The analyst also points out that a guidance cut often triggers negative reactions from investors, but in this case, they might be overreacting. She highlights that January and February typically see lower car sales in China due to seasonal trends. Moreover, she notes that NIO's Chinese rival, Li Auto, also downgraded its first quarter delivery guidance in March, indicating industry-wide challenges. Additionally, NIO's production and delivery disruptions due to model upgrades further impacted its performance. Despite these challenges, NIO delivered 30,053 units in the first quarter, with March deliveries showing a significant increase year over year and from the previous month. Furthermore, NIO's introduction of new 2024 models and the upcoming launch of its mass-market brand, Envo, are seen as potential drivers for sales growth. She emphasizes NIO's revamped battery-as-a-service program as a competitive advantage, allowing customers to buy cars without batteries at a lower price and rent batteries instead. Despite sales pressures from a price war and industry slowdown, she believes NIO expects margins to improve in the second quarter due to lower costs and higher volumes, potentially marking an inflection point for the stock. On the bearish side, another Motley Fool analyst has her own take on the challenges facing NIO and the broader electric vehicle sector. She points out that NIO isn't alone in experiencing a sharp decline in share price recently. Rivian, for instance, has seen its stock more than halve in 2024 and is now over 90% lower than 5 years ago. Even Tesla, while still significantly higher than 5 years back, has tumbled 31% this year. These declines reflect broader concerns affecting investor sentiment in the EV sector, including increasing competition, which is pushing down selling prices and hurting profit margins. Unlike Tesla, NIO remains loss-making, compounding investor worries. Moreover, shipping disruptions are complicating supply chains, potentially adding costs and delays. NIO's first quarter net loss of $690 million was 166% higher than in the prior year quarter, underscoring concerns about its business model. With sales growth potentially stalled and the company burning cash, investors are worried about the sustainability of NIO's business model and its ability to achieve profitability. If NIO continues to burn cash, it may need to dilute existing shareholders by issuing new shares to raise money, which could negatively impact its stock price. Considering the positive side of the equation, the analyst contemplates whether the current situation could mark an inflection point for NIO and the EV industry as a whole. Despite NIO's challenges in sales growth, it still maintains the steady output of a couple of thousand cars per week and has established itself as a premium brand with innovative battery swapping technology. This unique offering sets it apart from competitors whose vehicles rely solely on charging stations. With these factors in mind, the analyst suggests that NIO stock could be undervalued at present, presenting an opportunity for potential investors to capitalize on future growth and profit potential. However, she acknowledges the need for more evidence of sustained growth and profitability before considering an investment in NIO stock. This emphasis on NIO's unique offerings is designed to intrigue potential investors. Meanwhile, Investor Place has posted an article highlighting the challenges facing NIO stock. Down over 50% for the year and nearly 93% from its peak in 2021, the stock reflects ongoing headwinds impacting the company's performance. The outlook remains bleak despite management's efforts to address persistent issues, with further declines anticipated. Recent developments reveal continued downward pressure on NIO stock, exemplified by disappointing vehicle delivery numbers for Q1 2024. Although March saw an increase in deliveries, poor performance in January and February led to a 10% sequential decrease. Additionally, NIO's latest quarterly and annual results show significant losses, with net losses reaching nearly $3 billion for the full year. One of the factors contributing to NIO's challenges is China's slow post-COVID recovery, leading to a stagnation in EV demand and intensifying competition in the Chinese EV market. Despite NIO's efforts to differentiate itself with its battery swap gambit, which aims to increase demand for its vehicles, challenges persist. The costly infrastructure build-out for battery swap stations has yet to yield significant improvements in demand, raising concerns about the effectiveness of NIO's strategy. Ultimately, NIO struggles to gain ground and achieve profitability, cast doubt on its future prospects, leading to a recommendation to sell or avoid the stock. In fact, NIO stock has earned an F rating in Portfolio Grader, further underscoring the challenges it faces. But before we move on, we just want to thank you for watching this far. Going back to the bullish sentiment, Wall Street analyst from Morgan Stanley, Tim Xiao, believes that shares of Chinese EV company NIO could see significant growth. In a recent note, Xiao reiterated an overweight rating on the stock, forecasting a potential stock price of $10 per share, representing a 124% upside from its current level. Xiao and his team pointed out the relative strength in NIO sales, particularly in March, with SUV model sales growing over 40% month-over-month and smart electric sedan sales increasing by over 50%. The introduction of 2024 models, boasting enhanced computing power and competitiveness, is expected to further drive sales momentum. Additionally, NIO's battery as a service program, aimed at saving customers money upfront and providing quick battery replacements, is highlighted as a key differentiator in the highly competitive Chinese EV market. Despite the positive outlook, it's noted that broader economic conditions will continue to impact sales, and investors may need to exercise patience for the stock to reach Morgan Stanley's price target. Even with a reduced price target last month, Morgan Stanley remains optimistic about NIO's growth potential, emphasizing the importance of a broader economic recovery in China for the stock to achieve its full potential. So, as NIO is going through fluctuations, it's a reminder of how dynamic the stock market can be. Despite recent challenges, analysts like Tim Xiao from Morgan Stanley foresee potential for significant growth in NIO's stock, projecting a 124% upside from its current level. However, it's crucial to recognize that market trends can change rapidly, influenced by factors like economic conditions and industry competition. So now, how do you navigate such dynamic market movements when investing in stocks? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you're wondering about NIO stock, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.